My personal strategy generates the most gains during trending markets. So when I'm faced with a consolidation, there are certain things I do to protect my capital and also to make gains as the consolidation ends. And that's what I'm going to be showing you today. So let's get right into it. Now, firstly, let's talk about how I actually know when price is in a consolidation. So if I'm bullish and price has been trending like this, I'm essentially going to be anticipating that price is now going to run again after this retracement to go ahead and target this external range liquidity. Okay, so I identify a consolidation when price fails to do that and then comes back down into the leg and then also fails to take this low, right? So we get a failure swing here at the high. So we fail to take the external and then we also fail to come and take out this low here, right? Once price starts to do that, it's in a range essentially, right? And we don't know how long price is going to bounce around in this area for. Now, a very key thing to look for when it comes to identifying a consolidation is price building liquidity on both sides of the market. So when price actually forms this failure swing up here, you can see that it's essentially relative equal highs, right? So we're building liquidity there. And then if price was to come back deep into the leg, but also fail to take out this low, we've formed relative equal lows, right? So we've formed liquidity on both sides of the market. Now, one thing that I will say, one caveat to this, is if price was to form that failure swing and then the retracement wasn't too deep and it was just into, some kind of PD array like this, that doesn't mean that it's consolidating. It's probably just a retracement to go and actually target the high. When it comes to a consolidation, you'll see that this retracement comes very deep into the leg. And like I say, we form liquidity on both sides of the market. So once I see this, I know that price is in a range and could just do this continuously. So I stop trading, right? And it's very, very important when you see this that you stop trading and you wait for the confirmations that I'm going to give you before you engage again, right? Because if you were to engage in this and you was to say, let's say you bought again when price is down here, you don't know price is going to go and target this high. It's in a range. It will probably just keep going like this, right? So you're just going to take losses if you engage in that price action. So let's go over the bearish example, then we'll get into how to actually operate in these conditions. So essentially when price has been bearish, we're expecting a retracement into a PD array and then for price to impulse to the downside and form a new low. And I know that price is in a consolidation when we get that retracement, but then we fail to form a new low, and then price retraces pretty deep into the leg and forms liquidity on both sides of the market. So just like the bullish example, we have some kind of equal lows or low resistance liquidity on the downside, and we also form some kind of low resistance liquidity or equal highs to the upside, right? And price is in a range with liquidity on both sides of the market. That's how you know price is in a consolidation, and you should stop trading until you see what I'm about to show you. So once price builds liquidity on both sides of the market, we are not going to trade until price manipulates either side of the range. So until price manipulates the buy side liquidity or when price manipulates the sell side liquidity, right? The same for the bearish example. We're not trading until we see this side of the range breached or this side of the range breached, right? We have to see price break out of that consolidation and take some kind of liquidity. Once we see that, we can go ahead and engage and go and target the other side of the range, right? So let's say, for instance, we take out these lows. Once we see that and price starts to build bullish order flow, we can go ahead and trade that and target the other side of the range. So I'm showing you how to avoid losses and recognize a consolidation, but also how to profit from a consolidation once price tips his hand, right? Same for a bearish example. Let's say that price takes out this side of the range and then starts to build some kind of bearish order flow. You can go ahead and trade that and target the other side of the range, okay? But until price breaches one side of the range, we don't trade. Now you may be wondering, but what if we're bearish and price breaches the lower side of the range? Okay, now if you have higher time frame context backing this up, let's say for instance that this is on the 1 hour and price has just been moving down into some kind of daily FVG, then that's playable, right? Because you have a higher time frame bias. Let's say overall the daily's bullish. You have a bullish bias, right? It was just a small 1 hour move into that PD array. However, If this was like something on the weekly, right, this was the weekly chart and price takes out this low and you don't really have any bias for price to reverse from here, I personally just would sit that one out. The same for if it was bullish and we went and took out the high first. Personally, I'm only going to trade to the downside if I have a bias for price to move lower, because if the trend was bullish, right, leading up to the consolidation, ideally I'm going to look to continue the buys, right? So the ideal scenario, if you're bullish, is that price will take the lows of the consolidation and target the highs. And then the ideal scenario, if you're bearish, is that price will take the high of the consolidation and then target the lows, right? Because that way you're still continuing to trade with your higher time frame bias and everything is sweet. So that's the basics of how I would navigate a consolidation. But because of my strategy, there's actually two ways to play it, depending on if the consolidation was higher time frame or intraday. So let me show you what I'm talking about, and then we're going to go ahead and get into some examples. So let's say, for example, that this trend here was on something like the daily or the 4-hour or even the weekly, right? That means that this consolidation is going to be on a bit of a higher time frame, which also means when price breaches the low of the range and starts to build that bullish order flow that we want to catch to the upside, that order flow is also going to be on a bit of a higher time frame, like the 4-hour or the 1-hour or even the daily. So when it comes to me trading this as an intraday trader, I'm simply not going to execute off of, 4-hour or daily PD arrays, right? That's just not how I operate. So what I'll do instead is wait for these lows to tap into some kind of bullish PD array. And then within there, I'll look for my regular intraday model, which if you don't know what that is, essentially I look for some kind of liquidity sweep, right? And then I make sure that that's aligned with one of the daily cycles I use. So let's say this was a London protraction cycle. I'll essentially look for that and then get my entry on the lower time frame and target the upside, right, in London session if it was this daily cycle. So that is the model that I usually use. And essentially I'll just look for that within these lows that form within here. Okay, so that's how I would look at it if it was a higher time frame consolidation. Okay, so here on Euro USD on the daily, right, price has been bearish and we get a retracement into this bearish order block here. And then if I go on to the 4-hour, you can see that price reacts away from the bearish order block and fails to go ahead and make a new low. Right, we failed to make a new low. But it wasn't that big of a push, right? So it might not be that deep. But then price retraces and we form these relative equal highs here. And then again, price pushes to the downside. It doesn't go and make a new low. And we're actually now building low resistance liquidity here, right? We've built up relative equal highs and we've built relative equal lows, which confirms that we're in a consolidation. So from here, I would not trade and wait until one side of this consolidation gets breached. And because we're bearish on the higher time frame, ideally price will breach the high and then build bearish order flow to the downside. Let me play this out a little bit. You can see that we take out the high of the range and then we form this 4-hour CSD. Okay, so we start to form bearish PD arrays, which is the start of the formation of that bearish order flow. And then if I play this out a little bit more, we'll do it on the daily just because it's a lot of candles. If I play this out a little bit more, you can see that the daily from there melts off to the downside, right? And we go and eventually price does target this low of the range. So because this is on the higher time frame, I'm not going to go ahead and just go on the 4-hour and start executing off of these PD arrays. I mean, if you're a higher time frame trader and you trade off of 4-hour or 1-hour or daily entries, that is something you can do. That is how you can operate. But for me personally, I don't do that. So what I would actually be doing is marking out these order blocks and FVGs as my sell zones and simply waiting for my model on the intraday, right? So I'm essentially looking for price to sweep some kind of liquidity and align with some kind of bearish daily cycle. And then I'll go ahead and get a smaller entry on there and target this low. This next example, before we get into the lower time frame consolidations, is on GBP JPY, right? On the 4-hour, you can see we're in a bullish trend, right? So the higher time frame is bullish. And if we break down this consolidation here, you can see, first of all, price builds a bunch of relative equal highs at the top of the range. So we have liquidity on one side of the range, and then price retraces, and potentially from here, you'd be anticipating buys, right, from this FVG. You'd be anticipating that price pushes to the upside, but it fails to go ahead and actually make that new high, and fails, and then goes and forms this low resistance liquidity here, right? We build relative equal lows. So now price has built liquidity on both sides of the market. So you cannot say with confidence which side of the market price is going to target first, right? It could just go back and forth. So we don't trade. We sit on our hands and we wait for price to breach one side of the market. Again, because we're bullish on the higher time frame, ideally it's going to be the low, and then price builds bullish order flow that we can catch to the upside. So if I play this out a little bit on the 1 hour, you can see we breach the lows first, and we actually even added to these relative equal highs, right? So we have a bunch of liquidity on one side of the range. Now the other side of the range has been breached, we can look to trade in the direction of the high of the range, right? And if I play it out, you can see we do build bullish order flow targeting the other side of the range, and we hit it. Now personally, I like to enter, you know, on maybe like the 15-minute and make sure that it aligns with a daily cycle and a daily power of 3 and whatnot. I'm more of an intraday trader, so I'm not going to be executing off of these bullish PD arrays that formed. I'm going to be looking, like I said, for my model within that, right? Which is a little bit different to how I operate on the lower time frames, which is what I'm going to show you in a second. So yeah, again, this is how I would navigate a consolidation on the higher time frame. I would go ahead, wait for one side of the market to be breached, and then we go and we're trying to look for the model within these lows here when they tap into the PD arrays. Now, if you want that intraday model, I've broken it down into 4 simple steps and put it in a free PDF that you can access with the top link in the description. So now let's talk about how I operate a little bit differently with these lower time frame consolidations. So let's say, for example, that this trend was on the 15-minute. Now that means when price breaches the low of this consolidation and starts to build the bullish order flow to the upside, that order flow is going to be on something like the 15-minute or the 5-minute or the 3-minute, which is the time frames that I'm perfectly comfortable with executing on as an intraday trader. So within this order flow, we're going to be getting like a bullish CSD, maybe something like a bullish FVG, some kind of bullish arrays within that order flow that are on a time frame that I'm happy to execute off. So unlike the higher time frame consolidations where I'd be looking for my model to present within these retracements here, I can actually go ahead and just execute off of these bullish PD arrays, right? And you'll see that it goes very, very nicely with daily cycles, because we know that is the kill zones that have the highest probability of forming this sweep of liquidity, right? There's a high probability that that sweep of liquidity is going to occur in either London kill zone or that is going to occur in New York kill zone. And we also know there's a very high probability that the run to the buy side liquidity is going to occur in either New York kill zone or London kill zone. So knowing that, this is probably going to align with a daily cycle. So when it comes to executing off of these lower time frame consolidations, all I look for is that sweep of one side of the range, and then I make sure it aligns with a daily cycle, and then I just go ahead and execute off of these PD arrays. This first example of a lower time frame consolidation is on the 25th of October 2024 if you want to check it yourself. Essentially, we're on the 15-minute and price is bearish, and you can see that we got a retracement into this bearish FVG. So ideally from here, you'd anticipate that price will go and target this low. Okay? You'd expect that to be the target from the FVG. But as you can see, price failed to take out the low and ended up just forming relative equal lows, right? So we've built liquidity there. And if we look at these two highs, they're relatively equal. That is low resistance liquidity right there. Okay, so price is stuck in a range. We have liquidity on both sides of the market. So we're waiting for that to get swept. So if I play it out a little bit, you can see that's what happens, right? Price takes out the high of the range. And because we're bearish from here, we're expecting order flow to build and target the other side of the range. But remember, this is on the lower time frame, which means that this order flow that's going to build here is going to be on a time frame that we are comfortable executing on as intraday traders. Now, another thing we want to look for, because there's a high probability that a liquidity sweep and the run to the liquidity target occurs within a kill zone, that we want to look for one of the daily cycles. So if I put on the kill zones, you can see that this build-up of liquidity was actually in Asia session. Now, is that surprising to you? I talk about on this channel all the time, London protraction, Asia builds liquidity. And what have we got here? Asia building liquidity. So that's very, very nice. Then if we put on London kill zone, you can see it was London kill zone that swept out the liquidity. So you're seeing now how these daily cycles go hand in hand with navigating these intraday movements, especially when it comes to the build-up of liquidity in a lower time frame consolidation. So now we have the perfect example of a London protraction. So now all we need is an entry, right? We just need to see that bearish order flow build, and we can go ahead and catch the entry to the downside. So if I jump on a lower time frame, something like the 3 minute, and we play it out, we're looking for that lower time frame CSD, right? We're looking for price to switch on the lower time frame. It's actually a little bit cleaner on the 5 minute. You can see that we get this bearish order block that forms. So we get that bearish CSD. Potentially you enter off of the top of the range after we get that first formation of a bearish order block. If we play that out, you can see price starts to melt off. And even if you didn't take the first entry, you can see a 15-minute FVG forms here. And because we're expecting price to just hold this bearish order flow until we reach this liquidity, you can be very flexible with your entries, and you could have even just entered off of the 15-minute FVG, stop loss there. Maybe you just want to slap it at like a 1 to 2 or something. If I play this out, you can see price targets the other side of the range. It's perfectly aligned with the daily cycle. Now, this particular trade, I actually called out to the free Discord on Euro USD. If we have a look at Euro USD, you can see that we had a correlated movement to the upside, right? A nice bullish push in London. I called that out to the free Discord. Now, a disclaimer, it's not a signal service, it's not financial advice, but I do include all the details of my trades, including my entries. So if you want to join the free Discord, that's going to be the second link in the description. So this last example of how I would operate in a lower time frame consolidation is on gold. We're on the 13th of November 2024 if you want to check it out yourself. So here on the 15 minute, price is bearish. And essentially, you would anticipate that price would target this external range liquidity within this lower move here. But as you can see, price failed to reach the external range liquidity and started to retrace pretty deeply into the leg. So first of all, price has formed a failure swing and relative equal lows at the bottom of the range here. So we have liquidity on one side of the range. Then we get a retracement and it goes pretty deep back into the leg, and we end up forming a bunch of low resistance liquidity here, right? This high, and this high, they're all relatively equal. It's all low resistance liquidity. So we know now that price has formed liquidity on both sides of the market. So now we're not going to trade. We're going to wait for price to breach either side of the range. Because we're bearish, ideally it's going to be the high. And then we can go ahead and look for price to build bearish order flow to target the other side of the range. Because this is on the lower time frame, ideally it's going to align with a daily cycle, and we can go ahead and just execute straight off of the bearish order flow that forms. So let me play this out a little bit. You can see here that we get a sharp aggressive move to the upside that takes out the top of the range. So now ideally price should build bearish order flow to the downside. Another thing we want to look for is a daily cycle. So if I put the kill zones on, you can see this is Asia session, building liquidity. What a surprise. If we put on London kill zone, you can see London also played out and added to the liquidity. Then if we put on New York, you can see that it was New York that actually swept out the liquidity and took out both highs of the session. Now, if you've seen any of the videos on my channel where I talk about New York reversal cycle, this is a New York reversal daily cycle where essentially it is New York kill zone that manipulates. It can take out London and Asia high, and then we'll look for New York to run to the downside and target some kind of liquidity. So if I play this out a little bit more, you can see we get the confirmation of the bearish CSD. Right, we get a nice solid closure beneath these last up candles. So we get that CSD, which is now the bearish order flow forming. So we have the daily cycle, we have the bearish order flow. From here, it should be respected and hold very one-sidedly until we reach this low down here. So in terms of entry, I would say enter off the order block, but we're kind of far away from that now. Potentially price will tap into it, but we want to be a little bit conservative. So we can put our entry here at the 15 minute. Maybe you put your stop loss at the liquidity. Maybe you put your stop loss here at this high here. And we can target this low. It's not a very good risk to reward, so you probably just put it at 1 to 2. And if I play it out, you can see that that 15-minute FVG gets tagged. and then price runs to this liquidity down here, and we do eventually go ahead and take it out at a 1 to 2 risk to reward. So again, this is a very good example of how I would navigate a lower time frame consolidation using daily cycles and order flow. These last two examples utilize the London protraction cycle and the New York reversal cycle, but these concepts I'm teaching you work with all 8 of the daily cycles that I use, and you can start learning them for free by activating your 7-day free trial in the daily cycles program, which is going to be the third link in the description. It also comes with 6 technical courses, so make sure you take advantage of those too. I hope you found value in this video, and as always, I'll catch you on the next one.